Adobe just made, honestly, a $500 million gamble. And they're doing it while the two guys steering the ship are literally packing their bags.
Yeah, it's wild. I mean, it goes against everything you'd expect from a legacy software giant.
Exactly. Welcome to the Stock Tickers Deep Dive. We've got a massive stack of sources today that paint just a really wild picture of a tech giant in the middle of this unprecedented metamorphosis. We're looking at Adobe's Q2 fiscal year 2026 earnings call transcript, plus all those analyst notes from heavyweights like Wells Fargo Securities and Wolfe Research.
Right. And our mission here is to sort of strip away all that polished corporate PR spin, get rid of the dense Wall Street jargon and give you the actual data-forward reality of what's happening.
Which is essentially a legacy giant intentionally sabotaging its own guaranteed short-term revenue just to give away artificial intelligence tools for free. It's a massive AI land grab.
It really is. It's this calculated sacrifice that completely ignores the standard enterprise playbook. Usually, when a company has a monopoly grip on an industry, they just squeeze the users for every cent.
Right. The classic price hike.
Exactly. So the fact that they're consciously choosing not to do that and taking a quantifiable hit to their short-term metrics to do it tells us they see an existential threat on the horizon and a huge opportunity.
So let's start by looking at the raw numbers from this quarter, because before we can even unpack the pivot, we have to understand the baseline health of the business right now.
Yeah, let's look at the top line.
Q2 fiscal 2026 delivered record top-line revenue for Adobe. They brought in $6.62 billion for the quarter.
Which is massive.
It is. Now, the earnings release notes this is an 11% year-over-year growth in constant currency. We hear that term thrown around a lot.
Every multinational earnings call, yeah.
Yeah, right. But let's demystify it for a second. My understanding is that constant currency is essentially a way to grade the actual sales performance without letting foreign exchange rates ruin the test results.
That's a great way to put it.
Like if Adobe sells 1 million subscriptions in Europe, but the euro suddenly tanks against the dollar, their reported revenue looks terrible, even though they sold the exact same amount of software.
Right, so stripping that out shows the underlying business health. Wall Street wants to know if the actual demand is growing, independent of, macroeconomic currency swings that management just can't control.
Which makes sense.
Because if you're selling software globally, a strong US dollar actually hurts your reported revenue.
Yeah.
So citing 11% growth in constant currency proves the core sales engine is expanding at a double-digit rate.
And double-digit growth for a company already doing over $6 billion a quarter is it's a massive logistical feat. But the top line is only half the story here.
The bottom line is where it gets really fascinating.
Yeah, non-GAAP earnings per share came in at $5.96. That's an 18% year-over-year growth.
Wait, 18% EPS growth versus 11% revenue growth?
Exactly. Revenue grew 11%, but earnings grew 18%. But before we throw a parade for that gap, we need to talk about that term, non-GAAP.
Oh, the favorite debate of the finance world.
Right, because GAAP is the strict, standardized rule book for accounting. When a company reports non-GAAP earnings, they're basically saying, here's our profit if you let us ignore a few massive expenses.
Usually stock-based compensation.
Yeah, the millions they give in stock to engineers. Am I too cynical to think non-GAAP is just like a corporate diet plan where they don't count the calories from the cake?
I mean, no, it's a totally valid cynicism. Warren Buffett famously hates non-GAAP metrics. He always asks, if stock-based compensation isn't an expense, what is it? A gift from God.
Ah, right.
But in software, it's the standard language. Analysts accept it because it strips out non-cash expenses. Paying an engineer in stock dilutes the shareholders, sure, but it doesn't drain the actual cash reserves.
Okay, that makes sense.
So that $5.96 non-GAAP EPS shows the cash-generating efficiency of their core operations. And your point about the delta, the gap between revenue growth and profit growth, is the most crucial takeaway from this data.
Because right now, the whole narrative in tech is that the AI boom is this massive cash incinerator.
Oh, totally. A bottomless pit.
We're watching Microsoft and Meta spend tens of billions on NVIDIA chips and data centers. Their capital expenditures are through the roof. They're basically subsidizing the public's AI use just to hold on to market share.
Defending the turf at all costs.
Right, but Adobe's numbers show the exact opposite.
Yeah, they are defying the industry gravity right now. And 18% growth in earnings per share against 11% revenue growth means Adobe is experiencing massive operating leverage.
Which is incredibly hard to pull off.
It really is. They're embedding these wildly expensive generative AI tools, the Firefly models, into their software, running compute for millions of users and still expanding profit margins.
Management credited disciplined investments for that, right?
Yes, they aren't panic buying compute power. They've figured out how to run their AI efficiently enough that the bottom line is outpacing the top line.
That efficiency is a huge signal. But, as a TalkTickers investor, I'm always hunting for the recurring revenue. A one-time sale is nice, but subscriptions are the durable engine.
The holy grail.
So we look at the ARR, the annualized recurring revenue. Adobe reported total ending ARR hit $27.1 billion. That's a 12.5% year-over-year growth. But I have to throw a flag on the play here.
I know where you're going with this. The acquisition.
Right. That $27.1 billion includes a brand new massive acquisition, SEMrush. You can't just buy a company, slap their revenue onto yours, and call it organic growth.
It's a very necessary distinction. Okay. SEMrush added roughly $480 million to Adobe's total ARR pool.
Okay, so if we back that out.
If you back out that $480 million, the organic ARR growth is closer to the 10% or 11% mark. Still really healthy for a legacy incumbent, but SEMrush definitely inflated the headline percentage.
We'll dive into why they bought an SEO company later, because that is wild. But for now, looking at the pure subscription segments, the numbers are pretty revealing.
Yeah, let's pull the segments apart. Adobe historically splits its users into two buckets.
Right. You've got business professionals and consumers on one side, the people using Acrobat for leases or Express for flyers, and then creative and marketing professionals on the other side.
The high-end designers living inside Photoshop and Premiere. Let's look at the business professionals first. The subscription revenue there was $1.85 billion, which is a 15% increase year over year in constant currency.
Solid growth.
Solid. But the financial figure isn't the most staggering data point. They announced that their monthly active users, MAUs, for Acrobat and Adobe Express just surpassed 850 million.
Wait, 850 million?
Yep, every single month.
That's roughly 10% of the global population interacting with an Adobe product monthly. That scale is almost impossible to conceptualize. It rivals major social media networks.
And it grew from 700 million just a year prior. Adding 150 million active users in 12 months is phenomenal acceleration.
Wow.
And going back to whether AI is an incinerator or an engine for them, they gave a very specific metric. The Acrobat AI Assistant ARR grew approximately 3 times year over year.
Okay, let's pause and visualize what that actually is, because the Acrobat AI Assistant isn't just a generic chatbot sitting in your browser.
Right, it's embedded.
It reads the specific document you have open. If you have a 150-page legal contract, you don't read it. You ask, what are the termination clauses? And it instantly answers based purely on that PDF text.
Exactly. It turns a static document into an interactive database.
And you're saying that specific feature is seeing 300% growth in revenue?
Correct. It proves a huge thesis about AI monetization right now. Consumers are really resistant to paying for generalized chatbots because there are so many free options.
Why pay when ChatGPT is free, right?
Exactly. But when you embed a highly specialized AI directly into a workflow that a business professional already relies on, and it saves them 3 hours of reading and dense filing, the willingness to pay skyrockets.
The friction of copying and pasting into a separate window is just too high.
Adobe put the intelligence directly inside the viewer. The 3x ARR growth prove the market values that convenience.
That makes perfect sense for the business side. But what about the hardcore creatives, the people whose entire livelihood is making things look beautiful?
The core base.
Right. The creative and marketing professional segment brought in $4.54 billion in subscription revenue. That's an 11% growth. For the last 2 years, the fear was that AI tools like Midjourney would obliterate Adobe's core market.
It was a massive fear.
Why pay an illustrator for 3 days of Photoshop work when you can generate a hyper-realistic image in 10 seconds with a text prompt?
That was the innovator's dilemma facing them. Ignore generative AI, get disrupted, embrace it, cannibalize your own software.
So how did they solve it?
Firefly. They built a family of generative models designed to be deeply integrated into their existing applications rather than just being a standalone website. And the financial results show it's working.
The AI-first ARR, right?
Yeah. Management revealed that total AI-first ARR grew 3 times year over year, crossing the $500 million threshold.
$500 million in pure recurring revenue stemming directly from AI-first products. That just completely shuts down the bear thesis that Adobe is a dinosaur waiting to go extinct.
Totally. And they specified that Firefly's ending ARR is approaching $300 million just by itself.
That's a $300 million run rate business built practically overnight.
The reason Firefly is succeeding where skeptics thought it would fail really comes down to enterprise trust.
It's a copyright issue.
Exactly. A massive ad agency cannot use an open source AI image generator for a global Fortune 500 campaign. If the AI happens to generate an image that infringes on a copyrighted character, the legal liability is catastrophic.
The black box problem. You don't know what data the startup scraped from the internet to train its model.
Right. Adobe built Firefly differently. They trained it exclusively on Adobe stock images, openly licensed content, and public domain stuff.
So they own the rights to the training data.
Because of that, they offer enterprise customers full commercial indemnification. They basically tell massive brands, if you get sued for using a Firefly image, we will cover your legal bills.
Wow. A startup burning venture capital cannot offer that level of financial security?
Not at all. Adobe leveraged their massive balance sheet to create a commercially safe environment. That $300 million in ARR is enterprises paying a premium for peace of mind.
And speaking of that massive balance sheet, the cash flows are staggering. They reported $2.17 billion in cash flows from operations this quarter.
Just printing cash.
They exited Q2 with $5.63 billion in cash and short-term investments just sitting there, which gives them absolute operational freedom.
Which they are using to aggressively execute on shareholder returns. They repurchased about 8.5 million shares this quarter.
And they still have, what, $27 billion left for buybacks?
Approximately $27 billion remaining under their current authorizations, yeah. Including that new $25 billion one from April.
A $27 billion war chest just to buy their own stock. When management authorizes a number that large, that's a massive signal. They're declaring, our stock is cheap and we're buying it.
It's the ultimate shock absorber.
Right. If the market hits a rough patch and Adobe dips, management steps in, drops $1 billion, and retires millions of shares. It artificially constricts the supply, which boosts the EPS for everyone holding.
It is the ultimate flex of corporate maturity. So to summarize the raw data, double-digit revenue growth, expanding margins, explosive AI adoption generating $500 million in ARR, and an ironclad balance sheet.
It's a flawless quarter on paper.
On paper, yes.
But, Wall Street doesn't trade on yesterday's textbook. It trades on tomorrow's models. And the second half of this earnings call revealed a strategic pivot that just fundamentally alters everything moving forward.
We are definitely moving from a story of harvesting profits to a story of deferring them.
This brings us to the core narrative, and frankly, the most significant business model change Adobe has made since they killed off the box software and forced everyone into the Creative Cloud a decade ago.
That is a huge comparison. The shift to the cloud is taught in every MBA program as the gold standard of corporate evolution. You really think this current shift is on that same level?
I absolutely do, because it represents a complete reimagining of their customer acquisition funnel in response to a massive shift in consumer behavior. Management reported traffic to Adobe.com is just surging.
How much of a surge?
Overall traffic seeking Adobe capabilities is up 35% year over year. And in the creative segment specifically, inbound traffic grew over 50%.
A 50% spike for a 30-year-old company is not normal. That isn't just a clever ad campaign. That is a macro-level shift in what the public wants.
It's the democratization of capability driven by AI. Think about it. Before 2023, if you wanted to design a professional marketing asset, you needed a graphic designer.
Someone who spent hundreds of hours learning Photoshop layers and masks.
Exactly. Today, a small business owner just types, generate an image of a coffee cup on a rustic table at sunrise, and the AI produces it in seconds. The user's intent shifted from, I want to learn software, to, I want to instantly complete a task.
And historically, Adobe's website was optimized to capture professionals. If you landed there, the goal was to hit you with a paid funnel.
Sign up for a trial, give us your credit card, commit to $50 a month.
Right. It was a high-friction barrier designed to weed out tourists and lock in serious practitioners. They maximized the direct-to-pay journey.
But as David Wadhwani, the president of digital media, said on the call, hitting these millions of new task-oriented visitors with an immediate paywall is now a fatal error.
Because if a user just wants to quickly remove a background and you demand a $50 monthly commitment, they'll instantly bounce. They'll just go use Canva or Google Gemini.
The barrier to entry has dropped to zero. If you introduce friction, you lose the user. So Adobe's massive pivot is introducing this frictionless freemium tier.
Funneling that 50% traffic surge into free web-based tools.
Free access to Express, the web interface of Firefly, the Acrobat AI Assistant for basic tasks. And it's working. Wadhwani noted their creative freemium monthly active users jumped from 50 million to over 90 million year over year.
They nearly double their free user base in 12 months.
Gathering 90 million free users sounds like a massive victory, sure. But as investors, free is a dangerous word. Free users consume server bandwidth.
Oh, heavily.
And in the generative AI era, free users burn through immense amounts of extremely expensive cloud computing power every time they hit generate. Subsidizing the hobbies of 90 million people has to cost a fortune.
It does. And the cost of this land grab is where the earnings call got incredibly tense, because capturing 90 million free users is an enormously expensive financial choice.
This was the bombshell moment.
Yeah, management had to confess to Wall Street how they're paying for it.
CEO Shantanu Narayan explicitly stated that to fuel this freemium growth, they are actively deferring previously planned price optimizations.
Which is sanitized corporate speak for a price hike.
Right. Analysts had modeled a widespread increase in the cost of Creative Cloud for the second half of this fiscal year. It was supposed to be guaranteed cash. They have immense pricing power.
When Adobe raises prices by 5%, agencies just grumble and pay it.
Because they can't run their business without it. But Shantanu said, no, we're canceling that price hike. We are deferring it to focus entirely on accelerating creator acquisition through the free funnel.
It's an incredibly bold move to purposefully leave guaranteed revenue on the table. And the analysts did the math instantly. Alex Zukin from Wolf Research was pressing them on this during the Q&A, right?
Aggressively. He estimated that deferring the price hikes, plus the lost revenue from funneling traffic to free tools instead of paid trials, is going to cost Adobe roughly $500 million in organic ARR growth in the short term.
$500 million just wiped off the immediate projections. I have to play the terrified retail investor here for a second.
Please do. Why on earth would you do that? You have a captive audience of professionals who will pay whatever you ask. You could harvest that $500 million today, boost your EPS, and watch your stock soar. Instead, you throw it away to let 90 million teenagers generate free pixel art. It sounds like financial malpractice.
If you view it through the lens of a single quarter, it does look reckless. But you have to view this through a decade-long platform war. To understand the logic, look back at the Adobe Reader playbook.
Okay. I remember when you had to pay for software just to open documents. Walk me through that history because it feels really relevant.
In the early 90s, digital documents were chaos. If I wrote something in WordPerfect on a PC and sent it to your Mac, the formatting would completely break.
The fonts would change, layout ruined.
Adobe invented the PDF to solve this. It locked the visual design. But initially, Adobe charged money for the software required to just view the PDF.
Which inherently limited the network effect. If I send you a PDF, but you have to pay $50 to buy the viewer software, you're going to ask me to fax it instead. Yeah.
Exactly. The paid viewer throttled the adoption of the format. So Adobe made a radical decision. They made Adobe Acrobat Reader completely universally free.
Analysts probably thought they were insane back then, too.
They did. But the strategy was never about monetizing the viewer. By making the reader free, it became ubiquitous. Every computer pre-installed it.
And because they owned the free standard for viewing, they built an empire selling the expensive tools required to create and edit those PDFs.
The ultimate toll booth strategy.
You build a beautifully paved highway, let everyone drive for free, but you own the only construction company allowed to build the cars.
A perfect analogy. Fast forward to 2026. Shantanu Narayan is looking at the AI landscape and seeing the exact same inflection point. Generative AI is democratizing content creation, just like the internet democratized document distribution.
Right. And every tech giant, Google, OpenAI, Meta, is in a brutal zero-sum war to be the platform where this creation happens.
Yes. So if Adobe keeps their powerful AI tools locked behind a complex $50 a month paywall, the next generation will bypass them.
A 19-year-old college student making a startup logo won't buy Creative Cloud. They'll use Midjourney or Canva.
And here is the existential threat. If that 19-year-old gets comfortable with a competitor's interface, learns their prompting style, and stores their assets on their cloud, Adobe has lost them forever.
They haven't just lost one sale, they lost the lifetime value. Because when that student starts a real business, they'll just upgrade to the enterprise tier of whatever free tool they learned on.
So the freemium pivot is a massive defensive moat. By absorbing that 50% traffic surge and handing these 90 million users a free version of Firefly, they're attempting to lock in the behavioral habit before competitors can.
Building a habit was the exact phrasing management used, right?
Repeatedly. Wadhwani outlined the sequence. Let users upload a PDF to the free assistant, generate a graphic in Express, experience the magic without friction, build the habit before giving them the paywall.
I understand the defensive nature of it, but a business can't survive on defense alone. You can't just lose $500 million in ARR to build a moat. You eventually have to charge a toll. So I need the data proof of concept here. Does giving away free AI actually convert into paid revenue? Or are we subsidizing 90 million free riders?
Management was hyper-focused on proving the offensive capabilities of this funnel. They showed that the monetization engine is already firing for early cohorts.
Okay, let's dissect the conversion metrics. We established Firefly ARR is nearing $300 million. But how exactly is a free user turning into a paying customer?
It comes down to generative credits. When a user is on the free tier, they get a limited number of fast generation credits per month.
And once they exhaust those,
the generation speed slows down significantly or they hit a hard wall. Wadhwani noted that freemium users who convert to paid plans are highly engaged, showing significant credit consumption.
So it's a utility-based conversion, not just a 30-day time limit.
Exactly. Usage-based. Yeah. Once they experience the value and need more of it to finish a project, the friction of the paywall seems trivial compared to moving to a slower, unfamiliar tool.
And the velocity of that conversion?
It's aggressive.
Yeah.
ARR grew approximately 50% quarter over quarter, purely through Firefly standalone apps and credit pack purchases.
A 50% sequential jump in a single quarter proves the free tier isn't just a playground. It's a high conversion sales funnel.
It really is. And that's just the consumer side. We need to talk about the enterprise side because that's where the massive contracts live.
Let's do it. The marketing and analytics side is fascinating right now.
Anil Chakravarthy, president of Customer Experience Orchestration, gave an incredible update on enterprise integrations. He stated that over 80% of their Adobe Experience Platform and Experience Manager customers are now actively utilizing agentic capabilities built directly into the products.
Okay, I have to stop you. Agentic capabilities is one of those buzzwords flooding tech presentations, and it usually means nothing.
It does get overused, yeah.
When they say agentic, I'm picturing an AI that doesn't just passively draft an email when prompted, but actually has the agency to analyze data, make a decision, and execute a task autonomously.
Like a coworker.
Right, like an intern who doesn't just write the draft, but schedules the meeting and sends the calendar invites without being explicitly told. Am I getting that right, or is this just marketing fluff for a better chatbot?
No, your intern analogy is spot on. We're moving from generative AI to agentic AI. Generative is a tool. Write this description. Agentic is a coworker.
So what does that look like in Adobe's enterprise tools?
The AI analyzes real-time customer data. It realizes that, say, women in their 30s living in urban centers are abandoning their shopping carts at a high rate on a shoe brand's website.
Okay.
The AI agent autonomously decides to intervene. It uses Firefly to instantly generate a custom promotional image of those specific shoes in an urban setting. It writes personalized copy, builds the email, selects the optimal time of day to send it, and executes the campaign.
All without a human marketer pulling the levers.
Exactly.
That is legitimately science fiction turning into corporate reality. The efficiency gains for a massive ad agency are incalculable.
You don't need a 10-person team spending a week on a micro-campaign. The agent does it continuously. And enterprise customers are paying a premium for this. Adobe has 1,500 enterprise trials underway for their new agentic web offerings.
Staggering.
They even announced the general availability of a product literally called CX Enterprise Coworker.
Wow. And it clearly reflects in the financial success. Adobe Gen Studio, the operating system for a brand's content supply chain, saw its ending ARR grow over 25% year over year.
That 25% growth is foundational proof that large corporations are committed to Adobe's vision, which actually provides the perfect transition to the SEMrush acquisition.
Let's dig into that. You noted buying SEMrush added $480 million in ARR. For listeners who only know Photoshop, SEMrush is a massive public company primarily known for search engine optimization.
Right, tracking keyword rankings, analyzing competitor traffic.
When this was announced, I was incredibly skeptical. I need to push back on the strategy.
Let's hear the bear case. Why be skeptical of a highly profitable $480 million ARR addition?
Because traditional SEO feels like a depreciating asset right now. Google is rolling out AI overviews, where the AI simply answers the question directly at the top of the search results, completely bypassing the need for the user to click on a website.
A zero-click search fear.
Exactly. If zero-click AI searches destroy traditional web traffic, why spend billions to acquire a company whose entire model is built on optimizing for traditional search clicks? It feels like buying the world's best horse buggy manufacturer right after the Model T was invented.
That is a phenomenal question, and it's the exact fear that was driving SEMrush's stock price down before the acquisition. But Adobe isn't buying SEMrush to help people rank blue links on Google.
Okay, then what are they buying?
They're buying the underlying structural data of human intent. We have to reframe how we view the enterprise marketing supply chain.
Reframe it for me. How does a creative software company utilize an SEO database?
Look at the two halves of the equation. First, the inside-out data. This is what Adobe currently owns through GenStudio. They hold all the internal brand assets, product photography, brand guidelines, legal copy.
Right, the internal library.
But the internal library is useless if you don't know what the outside world actually wants. This is the outside-in data. How do consumers signal intent? They search.
On Google, on ChatGPT, on Amazon.
SEMrush possesses arguably the world's most comprehensive database of this external consumer intent. They know what keywords are trending, what questions people ask, and how competitors capture attention.
I'm starting to see the synergy.
Anil and Chakravarthy articulated this beautifully. Modern brands don't just want to rank on Google anymore. They want their carefully crafted messaging to show up as the authoritative answer when a user prompts an LLM like ChatGPT.
To do that, you have to connect the two halves. Let's walk through a practical example of how these two systems talk in real time. Imagine I'm running a marketing campaign for new running shoes.
Perfect. In the old workflow, a marketer stares at a SEMrush dashboard, notices a massive spike in searches for best waterproof trail running shoes for wide feet.
Then they have to write a brief, send it to a designer using Photoshop to make an image of a waterproof shoe, send it to a copywriter for SEO copy, and publish it weeks later. By the time it's live, the trend is over.
Highly manual, disconnected process. Now look at the integrated workflow. Because SEMrush is natively plugged into GenStudio, the system autonomously identifies that exact spike in intent.
And the agent triggers?
The CX Enterprise Coworker agent triggers a workflow. It pings the internal Adobe asset library, finds the 3D models for the new shoe, uses Firefly to instantly generate images of that shoe splashing in a puddle.
It uses the LLM optimized by SEMrush data to write an article structured to be cited by AI search engines, formats the landing page, and alerts a human for final approval.
It closes the loop entirely. It automates the entire supply chain from identifying a trend to deploying the personalized asset. You never leave the Adobe ecosystem.
It transforms Adobe from a tool to make a picture into the central nervous system of a brand's entire go-to-market strategy.
Exactly. That's why the acquisition makes sense. LLMs still need to scrape structured, authoritative data. By combining Adobe's content power with SEMrush's intent data, brands ensure they are the authoritative source. The $480 million in ARR is just the baseline.
Okay, we've outlined an incredibly ambitious vision, a massive pivot to freemium, deferring $500 million guaranteed revenue to build a 90 million user moat, integrating a massive SEO acquisition to automate the supply chain, rolling out autonomous agents.
A lot to execute.
It requires flawless execution. It requires a leadership team operating with total synchronicity and absolute stability. Which brings us to the most jarring and unnerving revelation of the entire call.
The executive shakeup.
While Adobe is attempting the most complex maneuver in its history, the C-suite is fundamentally fracturing.
It definitely demands deep scrutiny. Let's detail what was announced.
First, Dan Durn, the CFO, is exiting. This isn't a retirement or internal move. This is the guy who holds the purse strings. The architect of the financial models that justified taking a $500 million hit to ARR. He modeled the $25 billion buyback, and right in the middle, he's leaving.
And Shantanu explicitly noted, Durn is pursuing an opportunity outside the software industry entirely.
Which suggests a personal career pivot, not a competitor poaching him. But the timing is undeniably problematic. The CFO translates the grand vision into Wall Street spreadsheet models. Losing him now is a massive blow to stability.
But the instability doesn't stop there.
Right. CEO Shantanu Narayan, who has led Adobe for over 15 years and is considered one of the greatest tech CEOs of his generation, announced he is transitioning to executive board chair.
And the board initiated a formal CEO search to have a new leader installed by fiscal year 2027.
A simultaneous transition of the CEO and CFO is incredibly rare without a massive scandal or financial collapse, neither of which is present. So, putting on my retail investor hat again, warning sirens are blaring in my head. Uncertainty is the enemy of stock price stability. Shouldn't this terrify anyone holding Adobe stock?
That reaction is exactly how the algorithms and nervous portfolio managers reacted right after the call. Michael Turin from Wells Fargo bluntly asked Shantanu how they intend to manage this transition in a macro environment full of software disruption.
How did Shantanu defend it? Because if I'm a major shareholder, I need an incredibly convincing explanation.
His defense rested on two pillars: the depth of the existing bench and the strategic timing. Regarding the finance side, he pointed to interim CFO Steve Day, who has been a central pillar at Adobe for 20 years.
Okay, a 20-year veteran stepping in shows deep institutional memory. That stops the bleeding. But what about his own transition? How does a legendary CEO step down during an AI war?
He framed it as a meticulously planned succession. He stressed that moving to executive chair means he's not leaving the building. He's still driving the product roadmap. But more importantly, we have to read between the lines of why he's doing this now for FY27.
Let's theorize on that timing.
Look at the structural decisions he just made. He canceled the planned price hikes. He took the $500 million hit to short-term ARR to fund the Freemium acquisition.
That is a brutal pill for Wall Street.
Right. If a brand new CEO came in on day one and incinerated $500 million in guaranteed revenue to give away free software, the market would crucify them. The stock would plummet.
Exactly. But Shantanu has 15 years of flawless execution and immense credibility banked with Wall Street. He has the political capital to take that hit.
I see.
By absorbing the pain of the pivot now, he's essentially clearing the deck for his successor.
That is a brilliant interpretation. He's taking the bitter medicine while the trusted doctor is still in the room. By FY27, the new CEO won't have to defend a massive drop in ARR. They'll just inherit 90 million engaged free users and focus on monetizing them. It is a profound act of leadership. It ensures the new executive can focus on harvesting the seeds Shantanu planted.
Yeah.
However, the reality of the market is that it despises leadership vacuums.
Right. Even a planned succession can cause paralysis. Mid-level managers delay decisions, waiting for the new CEO. And moving slowly in AI is a death sentence.
Which makes the forward guidance for the rest of the year absolutely critical. They have to prove the engine is still firing.
And Steve Day delivered forward-looking numbers that were aggressively confident. Despite the shakeup and the costly freemium pivot, management actually raised their full-year FY26 targets.
Let's lay out those numbers. For total Adobe revenue, they're targeting between $26.5 billion and $26.6 billion.
Over $26 billion in a single year.
Breaking it down, business professionals and consumers should land between $7.44 and $7.48 billion. Creative and marketing professionals between $18.21 and $18.27 billion. And that includes the expected $280 million from SEMrush for the rest of the year.
Okay, so top line is secure. What about profitability?
Non-GAAP EPS is targeted at $24.35 to $24.45. Steve Day noted their internal modeling assumes a non-GAAP operating margin of approximately 45%.
45% operating margin. In software, anything above 20% is healthy. 30% is elite. 45% while funding 90 million free AI users and digesting a huge acquisition is bordering on financial wizardry.
It proves the sheer pricing power they have. However, there was one critical metric they actively tempered. They guided total Adobe ending ARR growth to 10.2% year over year.
Okay, Q2 ARR grew at 12.5%. Guiding 10.2% for the full year implied a significant deceleration in the back half of the year.
Yes, but management was aggressively transparent about why. Steve Day explicitly stated that this 10.2% target directly reflects the strategic choice to accelerate freemium growth and defer those price hikes.
They're looking Wall Street in the eye and saying, do not expect explosive ARR spikes in Q3 and Q4. We are trading short-term percentages for long-term acquisition.
Precisely. Day reiterated the internal conviction that this builds a foundation for durable growth in 2027 and beyond.
So let's connect this to the listener's portfolio mechanics. If I'm building a model or trading options, how does this alter historical seasonality? Enterprise software usually follows a predictable pattern.
Shantanu addressed this directly. Historically, second half ARR growth is a 40-60 split. 40% in Q3, 60% in Q4.
The classic Q4 budget flush where IT departments frantically spend their remaining budget so it doesn't get cut next year.
Exactly. But this year, because they're diverting traffic to free experiences, Shantanu warned the back half will be even more heavily weighted toward Q4.
So Q3 is going to absorb the brunt of the shock. The ARR growth in Q3 might look surprisingly soft.
Highly probable. For Q3, they're targeting revenue of $6.67 to $6.72 billion and EPS of $6.05 to $6.10. Solid, but ARR growth will visibly sag as the freemium funnel absorbs the initial influx.
They're telling investors to hold their breath through Q3, let the users play, build the habit, exhaust their credits, and convert when the Q4 flush hits.
Yes. And the enterprise side ADM and GenStudio remains strong and follows that seasonal trend directly into Q4, balancing out the consumer volatility.
Okay, we've excavated a massive amount of data today. Record beats, 90 million free users, the deferred price hike costing $500 million to build an AI moat, the SEMrush integration, the jarring executive exodus, and the soft Q3 ARR warning.
It is easily one of the most strategically dense quarters Adobe has reported in a decade.
Which means it's time to synthesize this into actionable reality. Expert, I need your ultimate talk tickers verdict. Looking at the long-term strategy, the short-term executive instability, the deferred revenue, is this fundamentally bullish or bearish?
I will take a definitive stance. If you separate the noise from the mechanics, this report is fiercely, undeniably bullish for the long-term trajectory. However, you absolutely must brace for significant short-term volatility.
Break down the bullish thesis first. Why so confident despite the $500 million hit to ARR?
Because they prove they can weaponize AI rather than being disrupted by it. 12 months ago, the fear was that Midjourney or OpenAI would render Photoshop obsolete.
The entire moat seemed to evaporate.
But Adobe leveraged their proprietary data to build Firefly and deployed it with precision. The fact that Firefly is approaching $300 million in ARR proves creatives and massive brands trust Adobe's models more than the legally ambiguous Wild West of open source AI.
That $500 million in total AI-first ARR is the proof of concept. They're monetizing it at scale.
Precisely. And the freemium pivot is the exact right maneuver for the decade ahead. Capturing 90 million users at the top of the funnel is worth exponentially more than squeezing a $500 million price hike out of captive users. They're capturing the next generation before startups can build enterprise sales teams.
I agree completely. The underlying engine is incredibly strong. But let's talk about the danger zone. Why the warning about short-term volatility?
Because public markets are short-sighted and reactionary. Over the next few quarters, the headlines won't focus on the brilliant Adobe Reader playbook. They'll focus on the C-suite turnover.
Uncertainty breeds selling pressure.
And the deferred price hikes mean Adobe's ARR growth won't look as explosive on paper as competitors forcing users to pay a premium for AI.
Wall Street adores a simple narrative. Raise prices, revenue goes up, stock goes up. Adobe is forcing them to digest a messy story. Flat prices, free compute, executive exodus, wait till next year for revenue.
Exactly. It's a hard story for a frantic day trader. It requires patient understanding of funnel mechanics. In the short term, sophistication loses to knee-jerk reactions. So expect turbulence as the soft Q3 numbers materialize and the CEO search drags on.
So how should an investor position themselves? If you're currently holding Adobe and your horizon is measured in years, what's the play?
The fundamentals dictate holding steady. You have to ignore the sensationalist headlines about the transition. The real payoff for the freemium pipeline and the SEMrush integration won't fully materialize until FY2027 and beyond. You're holding a company with a 45% margin and $27 billion authorized for buybacks. The financial floor is made of titanium.
And what if an investor is sitting on cash, trying to decide if Adobe is the right AI vehicle?
Patience is your greatest asset. The market's inevitable misunderstanding will create opportunities. Watch closely over the next 3 to 6 months. When the Q3 ARR prints slightly lower, the market will likely overreact and punish the stock.
The classic mispricing of strategic intent versus short-term metric?
Precisely. A dip caused by a deliberate delay in monetization to capture market share is vastly different from a dip caused by a flawed product. Adobe is sacrificing today to own tomorrow. If the market sells off impatiently, that creates a window to acquire shares of a dominant incumbent at a discount.
It's a profound corporate evolution. We've covered an immense landscape today. The non-GAAP financials, the psychology of the freemium strategy, the enterprise SEO supply chain, the C-suite shuffle.
It's a legacy giant, proving it has the agility to rewrite its own rules.
It truly is. As we wrap up this deep dive, I want to leave you, the listener, with a final provocative thought to chew on. Something that builds on this incredible scale, but looks at the broader implications for the creative world.
What's the lingering question?
We spend a lot of time praising Adobe for building commercially safe AI models like Firefly. Models trained exclusively on licensed Adobe stock images, offering brands protection from lawsuits. And they're offering these for free to 90 million users. But think about the foundation of that safe model. It was built on the backs of millions of independent artists, photographers, and illustrators who uploaded their human-made works to Adobe stock over the last decade, often for pennies in royalties.
The human labor that built the machine.
Exactly. So here's the question for you to mull over. If Adobe successfully trains a generation of 90 million free users to rely entirely on their AI to generate imagery, what happens to the independent human artists whose original painstaking work was used to train those very models? If a massive corporation can automate commercial art using an algorithm trained on human creativity, is this freemium pivot the ultimate democratization of art for the masses? Or is it the final, inescapable corporatization of human creativity? Think about it.
The tool becomes the creator, and the creator becomes the training data. It is the defining ethical tension of the next decade.
It absolutely is. And with that heavy thought, we wrap up today's analysis. Thank you for joining us on this deep dive into the data-forward reality of the market. As always, stay informed, stay curious, and we will catch you on the next deep dive.